All right, in this video, we're going to compare balance sheets between Tiffany and Flower Foods, or Tiffany Jewelry and Watch Store International. Flowers Foods is a bread company. They make bread, Sunbeam bread, and other things that you see in the grocery store primarily in the U.S. All right, a balance sheet is called a balance sheet because it has to balance. That means that the assets, which is what a company owns, has to balance with where they got the money to buy the assets. It's either liabilities or it's shareholders' equity. Now, most people just say equity in there. Shareholders for a corporation, yes, but in the Barth house, I own a house worth $350,000. That's the asset value. I owe roughly $75,000 is the liabilities that I still owe on the house, which means that my shareholders' equity or my equity in the house would be 275. I'm doing the math in my head correctly. That's what we mean by equity. It's just the value of the asset minus the value of the liabilities. Now, asset values are reported in a financial statement under GAAP based on historical cost. Okay, for the most part, it's what did the firm pay for? Assets are split up into two major categories. Current assets are short-term assets that'll turn into $1 within the next year. And non-current assets or long-term assets are the assets that are going to be used over multiple accounting periods. Okay, so the current assets and the non-current assets together add up to the total assets. When we're looking at assets, we also have tangible assets. Tangible assets are things that you can touch. All right, you can touch a building, you can touch land. And intangible assets, for example, the lease right of use asset. If you lease something, you do not own it, but you own the valuable right to use it. For instance, instead of buying a car, you could go lease one. What that does is give you the use of the car for 2 or 3 years, and then you give it back. All right, so that does create a value, though. There are other types of assets, intangible assets, like patents and copyrights, which also have value, but for a limited lifetime. A patent runs out. It's got an expiration date on it. A copyright has an expiration date on it. After the expiration date, anybody can use your stuff. So assets are either current or non-current. They can either be tangible or intangible. Intangible meaning that you can't actually touch them. They don't have a physical form. And within the tangible assets, they can be permanent tangible assets that there's not a limited a time limit on the use. For example, Coca-Cola's reputation, there's no end date on that, or the patent on their formula, their secret formula. That'll be with us for forever. But there are intangible assets that have a definite time limit on them that are only going to last for a certain amount of time and then go away. And we treat all of those assets a little bit differently, as discussed in the textbook, and we'll go into more detail in Module 4 and Module 5 when we start looking at amortization and depreciation of long-term assets. Okay, so that's part one of the balance sheet. All we're doing here is pointing out what goes into the asset categories, the asset buckets, in future modules, we'll look closer at the current assets individually, the non-current assets individually, and then at liabilities, and then at equities.